Good morning, good afternoon, and good evening. My name is Drew Pearson with Pearson Partners. I'm going to get out my crystal ball here and make some predictions and talk about some things that we do know and a lot of things we don't know about real estate as we move forward in the year 2022 and beyond. So here are some predictions I feel pretty confident in making. One, interest rates are going to continue to rise. It's May 2022. We've seen just over a 100 basis point increase, and we're going to continue to see that because the Fed has told us that. So I feel pretty good about that prediction. Two, inflation will continue to rise this year, next, and potentially the next because we have printed an unprecedented amount of money over the last couple of years. Three, oil and gas prices will continue to remain high over the next 2 to 3 years because of current administration in office. Regardless of your politics, this administration has been decreasing supply. Oil and gas is strictly a supply and demand-based model, so as we restrict supply, prices only increase. So those are kind of three things that I believe will be in our future for at least the short term. Now, how does this affect real estate and what does this really mean? Well, here are a few scenarios that can happen with increase in interest rates. One, nothing changes. Real estate continues on a breakneck pace. The velocity of deals continues at its current pace. Investors will simply accept a lower return because if their bank payments increase and their rate of return stays constant, well, now the gap is the rate of return. So maybe they'll just accept lower returns and keep on keeping on. Two, prices for real estate will decrease because as their bank payments increase, investors still want that same amount of return, so they have to decrease their prices to get that same level of return. Three, the velocity of transactions will simply slow down in the coming years. We'll have some institutional investors who have a lot of capital who need to continue to deploy that capital, like the teacher's pension fund. They have to buy a certain amount of real estate every year to keep the machine going. But we'll also see some smaller investors who will kind of hold off, saying, wow, things look overheated. Maybe if I wait, I can find a better opportunity in the future. And then the fourth thing is prices continue to climb. Margin of safety get thinner and thinner as investors believe that, hey, there will be someone after me who will pay a higher price than me because that is what's happened over the last couple of years. And all this will lead to higher default rates in the next 3 to 5 years as those loans come to maturity. High inflation, rising interest rates, and high oil prices reminds us a lot of the 70s under the Carter administration. And there was a lot of turmoil in the 70s because of those three primary factors. But here are two reasons that today is different than the 70s. One, there's a lot of capital sitting on the sidelines, both from high net worth individuals and institutions waiting to find attractive opportunities. Some of this was due to the COVID stimulus, and some of this was just due to stockpiles of cash because we've been in this 10, 12-year kind of bull market, generally speaking. Another thing that's different today than in the 70s is we have a supply and demand balance of residential real estate. And in fact, many would say an imbalance. We have more demand than supply. Right now, we have on average 1 to 2 months of housing stock available, and a balanced market is closer to 5 or 6 months. You have to put that together with high labor prices, high construction prices, where it's difficult to get those things in balance. So we have a very healthy real estate market, both on the residential and the commercial side. And really at the end of the day, one of the major factors that causes a real estate bubble to pop is a supply imbalance, meaning we have too much retail property for retailers. We have too many houses for people who want to buy the homes. So that's really interesting as we think about those balances and what causes bubbles to pop. Investors and investment allocators within real estate, what are we supposed to do with all this information? Is it best to put our head in the sand? Is it best to simply just wait around and say, well, I'm just going to wait for the next big shoe to drop, and I'm only going to buy things out of foreclosure? Well, maybe, but I think a more prudent approach is to continue to focus on value. And what do I mean by that? What is value? How can we seek value? And we at Pearson Partners have defined value, as we've learned from many others, is we want to buy properties below replacement costs, lease to tenants or customers at or below market rent, in stable markets. And there's a lot of nuance around that. What we don't want to do is just get caught in the emotion of greed saying, hey, I'm not worried about the downside. I'm not worried about all the things that could go wrong. I'm just going to look at all the rosy things that could go right. I'm going to think about, hey, we've seen prices appreciate by 20, 30% over the last 2 years. Surely they're going to do it again in the next 2 to 3 years, and I can get in and get out of this property and make a healthy profit in the short term. I don't think that's wise thinking, and that's something we at Pearson Partners strive very hard to do, is stay grounded in our fundamentals. We want to study the past. We want to study other great investors, whether that's in equities, whether that's in real estate. We want to define value, what our downside is, what our upside is, and continue to move forward in a prudent and logical and unemotional way as we try to navigate these waters of the next 3 to 5 years.